Welcome to the Depth Dive. Today, we're taking a peek behind the curtain at a company that's absolutely fundamental to how the internet works. Yet, honestly, it often flies under the radar. It's a really fascinating look at a truly unique player in the tech space. Okay, let's unpack this. We've gathered the analyses, research, all the notes on VeriSign Inc. That's ticker VRSN. And our mission here is simple. We want to pull out the most important nuggets for you, whether you're a seasoned American investor looking for stability or maybe just starting to build your portfolio. Our expert today is going to walk us through what makes VeriSign so interesting, even if it is kind of unseen.
That's right. VeriSign operates, well, right at the heart of the internet's infrastructure. Understand their business model, their unique financial strength, and the really almost monopolistic position they hold. That's crucial for any investor who's looking for, long-term stability and maybe some surprising value in their portfolio.
So let's start right at the beginning then. Most people, like you said, probably have no idea they interact with VeriSign every single day. What exactly is VeriSign?
Okay, so at its core, VeriSign is a leading internet infrastructure service provider. They specialize in internet domain name registration and, just as importantly, the security solutions that protect those names. Think of them maybe as the master librarians for the internet's address book. They manage the global.com and .net domains, those endings on almost every website you visit. That's them. And crucially, they also operate 2 of the 13 internet root servers worldwide.
Root servers?
Yeah, these are like the absolute master directories. They guide all internet traffic. Without them, your browser literally wouldn't know how to find google.com or, amazon.com. It's an incredibly critical foundational role.
Wow. So they're not just a place where I might go buy my domain name. They're the global registry for the big ones. That sounds incredibly powerful, almost like, a central bank for website addresses.
That's actually the perfect analogy, yeah. Their primary business model is built on these exclusive, long-standing contracts. Contracts for managing the registration in the database of all those .com and .net domains. And these aren't just, standard agreements. They're partnerships with key organizations like ICANN.
Right, ICANN. Heard of them.
Yeah, the International Body for Internet Addresses, and also the NTIA, which is part of the U.S. Department of Commerce. This exclusivity gives them what is effectively a monopoly in this core part of the internet. Now, they do offer some security services like DDoS protection.
Ah, right, protecting websites from attacks.
Exactly, shielding them from those massive attacks designed to knock them offline. But those services are actually a pretty minor part of their overall revenue. The really fascinating thing for investors is that this core business, the registry, generates incredibly stable and remarkably predictable revenue streams. They basically collect a small fee for every single .com and .net domain registered or renewed, globally, year after year.
Wow. Okay, so they're essentially collecting rent on a huge slice of the internet. So here's where it gets really interesting for me. A business model like that, such a foundational role, that must lead to some pretty impressive numbers, right? Does that translate to, a rock-solid financial picture?
It absolutely does, and it's truly remarkable. VeriSign's financials are exceptionally robust. So for 2024, their total revenue was $1.56 billion. That's a solid 4.3% increase from 2023. Their operating profit, even better, reached $1.06 billion, which is up 6.0%. Net income for 2024 landed at $786 million. Now, okay, that was a slight decrease in the year before.
Right. Any reason why?
Yeah, it was mainly due to some specific tax-related factors. It wasn't really a sign of a business slowdown.
Got it. And what about more recently? Have they reported lately?
They have, actually. Just 5 days ago, they announced their 2025 Q1 results. Revenue was $402.3 million, so up 4.7% from Q1 last year. That met analyst consensus right on money. Their diluted EPS, earnings per share, was $2.10. That's up from $1.92 year over year. It did slightly miss the consensus estimate, which was $2.25.
Okay, so a slight miss on EPS, but revenue growth still looks pretty consistent.
Exactly. And for seasoned investors, they'll spot that right away. The underlying business trend is still solid.
Those are strong top-line numbers, sure. But profitability, that's often the real test for a business like this, isn't it? How do they stack up there?
This is where VeriSign truly shines. And it connects directly back to that unique, almost monopolistic business model we talked about. Their trailing 12 months, or TTM, profitability metrics are exceptionally high. Just look at these numbers. Gross margin is around 87%.
87%? Wow.
Yeah. Operating margin, approximately 68%. Net margin, about 50%. And their EBITDA margin, a remarkable 70.32%.
It's a 70% EBITDA margin.
That's huge. It is. And for folks maybe newer to financial statements, these aren't just high numbers. They really represent that incredible pricing power and the minimal variable costs that come from being the Internet's essential address book. It basically means VeriSign generates a ton of cash once their infrastructure is in place, and their balance sheet reflects that. As of Q1 this year, they had $649 million in cash and equivalents. They maintained very low debt levels, too. Excellent financial health. And cash flow? Rock solid. Operating cash flow was $903 million in 2024, and in Q1 2025, $291 million. That's up nicely from $257 million the year before. This strong, consistent cash flow is really the bedrock for their investments and, critically, their shareholder returns.
Okay, so this robust financial picture, what does it mean for you, the American investor, when you're actually looking at their stock? How do these impressive financials translate into the investment metrics we look at?
Right. For investors, these financials paint a really clear picture of a stable, highly profitable company. The current stock price, as of July 29, 2025, is around $284.10. That gives them a market cap of about $26.59 billion. Their TTM/PE ratio is running about 33. Now, for a tech company, especially one with this kind of stability and unique market position, that's quite reasonable.
33 PE.
Yeah.
Yeah, not astronomical for tech, especially stable tech.
Exactly. And the EV/EBITDA is around 23.7. EV, enterprise value, includes debt and equity. Again, that metric seems pretty appropriate for a company generating this much profit.
Now, here's an interesting one. Their return on equity, ROE, it's over 100%.
Over 100% ROE. How does that happen? Does that mean huge debt? That's a great question. Sometimes high ROE can indicate a lot of leverage, yeah. But in VeriSign's case, it primarily shows that the company is actively returning capital to shareholders, mostly through aggressive share buybacks. It signals incredible efficiency rather than just excessive debt. You have to look at their capital structure, which shows strong cash generation, reducing the need for debt. Their return on assets, ROA, is also very high, around 33%. Now, in terms of projected growth, analysts are expecting annual revenue growth around 6.5% and EPS growth maybe 13%.
Okay, so stable, but not exactly explosive growth like some tech startups.
Precisely. This isn't high growth territory. It's stable, consistent growth, which makes sense for a core infrastructure provider.
Right. So beyond the balance sheet health, what about direct returns to shareholders? You mentioned buybacks, but are they paying dividends too?
Oh, absolutely. VeriSign has a very consistent dividend policy. They pay quarterly, and those dividends have steadily increased over time. It really demonstrates a clear commitment to shareholder returns. The latest declared dividend is $0.77 per share, expected around August 19th. Their trailing 12 months dividend yield is about 1.11%.
Okay, 1.11%. Not huge, but steady.
Right. But what's particularly noteworthy here is their payout ratio. It's incredibly low, just 9.02%.
9%. Wow, that is low. So they're keeping most of their profits.
Exactly. They're only paying out a small fraction as dividends. Most of it gets reinvested or, more significantly, used for that active share buyback program we talked about. In 2024 alone, they bought back a staggering $1.21 billion worth of their own shares.
$1.2 billion in buybacks.
Yeah, and reducing those outstanding shares directly increases earnings per share, which is a major driver of shareholder value, especially for a mature, cash-rich company like this.
Okay, so we've established their unique, almost monopoly-like position in these really impressive financials. Now, the real question, how does VeriSign manage in its market? Are their rivals actually trying to take its top spot, or is this really as impenetrable as it sounds?
For the most part, it really is as impenetrable as it sounds. VeriSign operates in an industry that's just essential. DNS is fundamental internet infrastructure, and their role is highly regulated, remember, by ICANN and the NTIA. Once their systems are up and running, it's a very high-margin business. Now, competition. For .com and .net top-level domains, VeriSign has essentially no direct competition.
None.
None. That's down to those exclusive government-backed contracts. It's a unique monopolistic position. However, they do face indirect competition. This comes from, the explosion of new top-level domains like .xyz or .app or hundreds of others. They offer alternatives, sure, but none have anywhere near the established recognition or ubiquity of .com. They also compete indirectly in the security services space, with players like Cloudflare and Akamai. But again, that's a pretty minor part of their revenue picture.
It really sounds like an unassailable fortress almost. So what's their secret weapon, their moat, as investors call it? What makes them so resilient in this fast-paced tech world?
Well, their moat is incredibly strong. Yeah, it's built on several key pillars. First and foremost, obviously, are those virtually exclusive contracts for .com and .net. That gives them an unparalleled market position.
Mm.
Second, you have high switching costs for domain users. It's a significant hassle and potentially expensive for a business to change its core domain name once it's established.
Right, you build your whole brand around it.
Exactly. Third, VeriSign plays that absolutely essential and frankly irreplaceable role in the internet ecosystem. The internet literally relies on their infrastructure to function seamlessly every second of every day.
Right.
And finally, they've built up decades of brand trust and operational reliability. That's a huge competitive advantage where uptime and security are absolutely paramount. It basically means VeriSign is almost immune to the kind of competition you see shaking up other tech sectors because their service is just non-negotiable for internet functionality.
Okay, given that very unique position, what about the big tech trends we always hear about, AI, blockchain? Could these disrupt VeriSign's really stable business, or are they kind of insulated?
That's a really crucial question for any long-term investor thinking about this stock. For AI, well, there are certainly opportunities. VeriSign could use AI to enhance their cybersecurity offerings, make operations more efficient. But it also presents a risk, right? As cyber attackers could start using more sophisticated AI-powered tools against them. VeriSign has publicly said they're taking a cautious approach to AI integration, which seems prudent given how critical their infrastructure is.
Cautious makes sense there. What about blockchain and Web3? We hear about decentralized alternatives.
Right, blockchain and the decentralized Web3. This poses a potential long-term, maybe more theoretical threat at this point. You have things like decentralized domain systems, Ethereum Name Service, or ENS is one example. They aim to offer alternatives to the current centralized DNS system VeriSign manages. But realistically, right now, they face pretty significant technical hurdles and commercial limitations. They aren't really a widespread alternative that poses an immediate threat to VeriSign's core business. Not yet, anyway.
So more of a watch this space kind of thing.
Exactly. Now, other trends like the Internet of Things, IoT, and 5G expansion, those could actually boost long-term demand for domains and IP addresses. More connected devices means more internet addresses needed, potentially benefiting VeriSign's core business and maybe even their security services down the line. So, yeah, summing it up, VeriSign needs to balance its deep focus on core stability with a, careful eye on these emerging techs. They could offer opportunities, but also pose long-term threats, though the immediate impact seems pretty limited.
Okay, interesting. Now, stepping outside the tech world itself, how do broader economic factors, things like interest rates or inflation, affect VeriSign? I mean, they're essentially charging rent on the internet, right?
Right, and that unique model makes them surprisingly resilient to certain macro factors. Take interest rate fluctuations. They have a limited direct impact because VeriSign has such stable cash flow and very low debt. In fact, in a rising rate environment, some might even see them as a defensive stock because that revenue is so predictable. However, higher rates do generally depress valuation models like DCF, discounted cash flow. That affects most stocks. Inflation, on the other hand, this is where VeriSign has a distinct advantage. Thanks to that near monopolistic position, they have strong price pass-through ability. They can and do raise domain fees periodically to offset inflation.
Ah, so they're a pretty good inflation hedge then.
Potentially, yes. A very good one. Now, global economic growth, that does have an indirect sensitivity. A global economic slowdown or maybe a downturn in a specific big region like China, that can lead to a decrease in new domain registrations. Businesses might scale back online expansion plans. And lastly, well, it is a tech stock, technically, so it can be influenced by overall market sentiment towards the tech sector, even if its fundamentals are quite different from, say, a high-growth software company.
Okay, that makes sense. But look, no investment is completely without risk, right? Even for a company with such a strong moat. What are the key potential dangers investors really need to be aware of with VeriSign?
Absolutely right. Despite that formidable position, VeriSign does carry a few key risks investors need to watch. The biggest one, I would argue, is regulatory risk. Their entire core business hinges on those contracts with ICANN and the NTIA. Now, they've been renewed successfully for many years, but any future changes to the renewal terms or critically to the allowed pricing terms, they could really cap their ability to raise fees and directly impact profitability.
So contract renewals are key moments to watch.
Definitely. Second, there's that technological disruption risk. We touched on it. While it seems low currently, the long-term theoretical threat from blockchain domains or maybe entirely new internet protocols could someday undermine their core business, though realistically that seems decades away if it ever happens. Then there's market growth slowdown or saturation risk. The .com and .net markets are mature. They're not growing like they used to. If new registrations slow significantly, or if competition from all those new TLDs like .xyz actually starts to bite more, it could impact their future growth rate. Cybersecurity risk is also a big one. As absolutely critical internet infrastructure, VeriSign is a prime target for sophisticated cyber attacks. Any major service disruption, or worse, a significant data breach, that would be extremely costly, both financially and crucially, to their reputation for reliability. And finally, you have broader macroeconomic and geopolitical risks, global slowdowns hitting domain demand, like we mentioned, and also, potential splinternet scenarios where the internet gets fragmented along national lines. That could really affect the integrity of the global domain system they manage.
Okay, quite a few things to keep an eye on there, even with the strong base. So we've talked about the risks, but let's pull back again. What makes VeriSign so inherently strong and stable despite those potential headwinds? What are its core internal capabilities?
Yeah, their strength really comes from several core internal capabilities they've built over decades. Firstly, just their operational expertise and stability. VeriSign has over 20 years of reliably managing this critical DNS infrastructure. Remember, 2 of the world's 13 root servers. They do this with near-perfect uptime while handling massive traffic volumes. That operational track record is, frankly, almost unmatched globally. Secondly, their security expertise is absolutely top tier. They have to be. They employ cutting-edge cybersecurity tech and highly skilled people to protect this vital infrastructure from constant threats.
Makes sense. They have to be good at that.
They have to be. Thirdly, their regulatory relationship management. This is a huge, often underestimated asset. They've built deep, trusted relationships with ICANN and the NTIA over decades. That lets them proactively respond to regulatory shifts and navigate really complex policy environments. And, well, we can't overstate their financial strength. Those high operating margins, that robust, predictable cash flow, which they then efficiently allocate back to shareholders through dividends and those big buybacks. Plus, low debt. It's a financial fortress. Lastly, their key talent and leadership. They have a highly skilled technical staff, obviously, but also an experienced, long-tenured management team providing stability and strategic direction.
That paints a really powerful picture of stability, definitely. So what's the general market sentiment around VeriSign from an investor's point of view? How do the big institutional investors see it?
Right, market sentiment. Well, there are strong positive factors that investors clearly appreciate. They see VeriSign as that essential infrastructure provider, the monopolistic position, the defensive characteristics against economic downturns. That consistent cash flow is a huge draw. However, there are also negative factors or maybe concerns. We mentioned the worries about future growth rates in a mature market, and its stability often commands a valuation premium. The stock might look a bit expensive sometimes based on traditional value metrics because you're paying for that safety.
The safety premium.
Exactly. And that ongoing regulatory risk, plus the potential long-term competition from new TLDs, those are always on investors' minds. In terms of supply and demand for the stock itself, VeriSign enjoys really high institutional ownership. You see names like Vanguard, BlackRock, State Street as major holders. That suggests strong investor confidence, and it also contributes to its price stability. And again, those active share buyback programs constantly reduce the number of outstanding shares, supporting the per-share value. Finally, just looking quickly at shareholder info, the company has stable management, average tenure around 7.2 years, a strong board too, average 10.4 years, and management's direct share ownership is about 0.5%, 0.51%, which helps align their interests pretty well with shareholders.
Okay, so bringing all these pieces together now, how should you, our listener, the American investor, sort of contextualize VeriSign as a potential addition to your investment strategy? What's the takeaway?
All right, the takeaway. From an investment perspective, VeriSign definitely presents several strong positives for the American investor. You've got that powerful competitive moat from the exclusive contracts, the excellent financial health, high margins, strong cash flow, the consistent shareholder returns via dividends and significant buybacks, and those defensive characteristics that make it relatively resilient to economic bumps. However, the key considerations, the risks. You have to expect stable rather than dramatic growth. That's key. You have to be aware of the potential for that premium valuation because of its unique position. And you absolutely need ongoing monitoring for any regulatory changes and the potential long-term impact of those new top-level domains. So in conclusion, I'd say VeriSign fits more as a value and dividend growth stock. It's not a pure high-growth tech play.
Right. More stability, less sizzle, maybe.
Exactly. It could be a